Hello, everyone, on this Monday, the 6th of February. Today on the final bar, you will once again have to deal with me, but the good news is that Dave Keller will be back on the show tomorrow, completely refreshed and with a ton of new ideas, I'm sure of that. For today, I'm going to slightly hijack the show, putting in a sector spotlight-like overview of current rotations. And for the Monday mailbag segment, I will be pulling some of the questions from the sector spotlight mailbag. Other than that, ladies and gentlemen, this is still the final bar. Hello, everyone. Dave is still enjoying his long weekend, and I am practicing to smile throughout the show. So please stick with me for one more day before the man is back. My name is Julius de Kempenaer, and I'm presenting to you from Amsterdam in the Netherlands, where we actually are starting to see some sun again after a very long, dark, and rainy period. And here on the farm where we live, that means mud, 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 and mud again. And sometimes the markets look like a pool of mud. These days, after a big week of earnings and macroeconomic data, things seem to be cooling down a little bit. So let's see what the market presented us today with the start of a new week. And of course, we will use the tools available here to us on StockCharts.com. Let's start a quick look at a market recap. Market just closed and Dow down only slightly, S&P 0.6%, Nasdaq lost the most with 1%. Broader market, NYSE down 60 basis points. All in all, not major, nothing really major. We go to bond markets, then they obviously went up slightly. We look at commodities, we see some mixed bag in the metals, oil, nat gas, gasoline, all up. And in the crypto space, it's a mixed bag, not very much, especially on the crypto values that you normally see. Those percentages mean absolutely nothing. Let me go to that grid that I introduced to you last Friday, what I used to go over my, basically get a handle overview of what's happened in the market today. Let me click away this sidebar here. And if we blow up this S&P chart here, then I think we saw a nice rally, and then it sold off a little bit on Friday. And what we saw today is that initially market went down, and look at the low here, 4,093 something, and the high here, 4,094. I say that is a very good example of resistance becoming support. And what I like is that the market, despite the mixed bag of news, and especially some of the earnings reports that came in last week, there were quite disappointing for a few of the big mega cap names, the market isn't selling through it. So right now we're holding at that old resistance level that's acting as support right now. So I'm taking this little sell-off, couldn't even call it a sell-off, this little wave of selling as sort of a correction, a sort of pullback after a breakout. So that's the good news for today. And you see that through pretty much all indices. The Dow is a little bit of an outlier. That's much more sideways. You can see that there is no big rally into that, and there's also not so much of a sell-off going on in the Dow. Much more subtle, much more relaxed maybe. And here the Nasdaq, obviously bigger rally. But the good news is that, as you can see, the S&P went all the way back to that high of last week. The Nasdaq didn't do that, put in a low at significantly higher levels, closed that gap. And what it tells me, basically these highs and lows, what they tell you is that buyers were more aggressive. They were coming in at higher levels. So I take that as a good sign for the market for the moment. If we have a quick look at the bond markets, because I think there's some interesting things going on right there. You see that the market moved down, and here also these horizontal levels on this 30-minute chart, by the way, we're looking at 30-minute charts. are all in that kind of same area. So this is quite an important support area for the bond market. If we will see TLT going below 105, that could be an interesting thing to take into account. But for the time being, I expect the bond market to find support here. And when the bonds start to move up, yields go down, and that's usually a good sign for the stock market. So that could help the S&P and the NASDAQ to remain above their support levels. Very quickly to the small cap and mid cap indices, you can see here they got hit a little bit harder. This is actually a nice double top formation. There is slightly more downside. However, when they hold up here again, you can see how these markets are holding up at that previous low that was set earlier today, right after the open. This is an area where you can find divergence building up. And that is also, there is quite a bit of downside that the market has leeway to go down without damaging the improvement that we've seen over the last few weeks. So I think that's my take for the current markets, how it's going. Selling off last Friday right now, but not too bad. And even with some of that weaker earnings reports that are coming in, maybe I'm not surprised. I shouldn't be surprised, but I like that I see that the market is not taking that bad news too bad. They're actually responding pretty well to a few of those nasty news messages. And I think that we should take that at least as a warning sign for a little bit more of an improvement. Okay, I'm going to leave it at this for the market update segment. And we're going on to a sector deep dive. And as I told you in the beginning, we're going to hijack the show a little bit, because what I'm going to do is I'm going to use RRGs and I'm going to talk a little bit like I would do on Sector Spotlight, which, by the way, you can see tomorrow, Tuesday, 10:30 to 11 a.m. Eastern. And the reason that I'm hijacking the show here with these rotation charts is that on the first Tuesday of the month, I always deal with the monthly charts. It's a really long-term picture. And I didn't do the seasonality bit, which I usually do at the last Tuesday of the month. So I'm going to scramp all of that in tomorrow's show, which means that we wouldn't be able to do the current market rotations. But hey, here we are on the final bar with about 7 minutes to talk about sector rotation. Look at this RRG here. This is a weekly RRG, and it's quite interesting to see that usually these tails are spread out. And what you see here is there is one half in the improving quadrant, and the other half is in the weakening quadrant. There are no sectors inside leading, and there are no sectors inside lagging. I think that what this shows you is sector rotation on the run. This whole group of yellows is coming out of a period of leading, and they're now rotating through weakening on the way to lagging. We know that the negative heading, when that tail points into a compass heading between 180 and 270, that's usually a negative. And when you see headings that are pointing between 0 and 90 degrees, that's usually a positive. So all of these are positive, with the exception of utilities. We're going to look at that in a minute. And all of these are losing it. The good news is that the heavyweights, and those are technology, which is XLK, which is right here, and consumer discretionary is right here. And those two sectors with the mega cap names in it, communication services, the sector as such is not too big, but it's got Meta in it, which is a major mega cap stock, of course. And all these that have these mega cap names are moving in the right direction on this weekly chart. So I think that is super interesting. And I'm going to show you a little trick. What I'm going to do here is I'm actually going to snap these two side by side, which allows me to show you the chart that belongs to the tail side by side. So if we start with consumer discretionary, that is the sector that has kept the market under pressure for quite some time. And you can see that it now is coming out of that lagging quadrant and just crossed over into improving. And it's actually following, of course, because this is a derivative of this. So it's following what's happening on the price chart, but more importantly on the relative chart. You can see that weakness in relative strength. And now we're in raw relative strength. I call this raw relative strength. is moving back above resistance. This old support level here acted as resistance. It's now taken out. Combine that with the break above this falling trend line and taking out this cluster of highs. And especially after last week, being able to hold above that breakout level. That's pushing these RRG lines higher. And that is making consumer discretionary a sector to watch, especially when Amazon and Tesla are starting to show some improvement there. We go to XLC, Communication Services. That sector is, from a RS momentum point of view, it's the highest reading. So this has been working its way higher already since late December. That improvement started to become visible at the end of last year. And we got the confirmation here. This was the week of January 9, when we broke out of that double bottom, started to accelerate. We took out some falling resistance and relative strength. And we're now pushing successively above previous highs. And we just ran into resistance around 60. That was last week's high. But again, we're still holding above that former breakout level. So that is a matter of strength. And that is keeping that tail moving into the right direction. XLRE, same story. Technology, of course, we need to look at technology. Everybody likes technology. So here's tech. Same story. Taking out that falling resistance line last week, breaking above resistance with a little dip at the end of last week, but today we're holding. So for this week, obviously this is only today. This is a weekly bar chart, so this one is still building up. It needs 4 more days. But when technology holds above 130.50, 139, especially on Friday's close, that will have a positive impact on this tail, pushing it further towards the leading quadrant. A word of caution, or, well, not a word of caution, it's also a sign of strength. And I showed you this last week again, but it's still going on. If you look at the defensive sectors, and the defensive sectors are utilities, which you see here inside improving, but rolling over, and we know when something's rolling over inside the improving quadrant back to lagging, that's a new lag, a new down lag building up in an already existing declining relative trend. The other defensive sectors are healthcare, and you can see that that is inside weakening and pushing towards the lagging quadrant. And the other one is consumer staples, and it's showing the same. So we have three defensive sectors at a negative heading, while you would expect these sectors to do bad in a strong market. So the fact that these defensive sectors are now at a negative heading with utilities already pointing back to the lagging quadrant tells me that under the hood there is improvement going on. Market is improving. Market is getting out of defense and getting back into discretionary technology and communication services. We have to see what's happening here. There's a couple of offensive and sensitive sectors still on the right. Sectors like energy, industrials, materials, they can still have the possibility. There's a little bit of room that they can curl back up and move back towards that leading quadrant, which would actually be a very good sign because it will underscore the underlying strength of the market at the moment. So all in all, wrapping it up from a sector rotational point of view, defensive sectors, with the fact that they're moving in a negative direction, are sending a strong signal for the market. And we see discretionary tech and communication services actually continuing their push into the right direction, supporting a higher S&P 500. We're going to wrap up this segment. We're going to go for a quick break. And after that, we'll be back with questions from the mailbag, the Sector Spotlight mailbag. Welcome back, everyone. Here's my smile again. Once again, I'm Julius de Kempenaer, continuing to coming for you live from Amsterdam in the Netherlands. In a minute, we're going to continue on with the final mailbag segment, for which I have pulled a few questions from the Sector Spotlight mailbag. But first, we like to encourage you to send in your questions so they can be answered live on air. We love to hear from you. Our email is thefinalbar@stockcharts.com, and you can tweet us at @finalbarsctv, and that's @finalbarsctv on Twitter. or you can put a comment below the video if you're watching it on our YouTube channel. Also, I want to encourage you to go to our on-demand platform where you can watch all the StockCharts TV shows at any time during the day. The website is stockchartstv.com. Don't forget to go on any on the OTT channels, Amazon, Apple, Roku, all of stockcharts.com is everywhere. And don't forget to check out Sector Spotlight every Tuesday from 10:30 to 11 a.m. Eastern. Finally, here are the guests that will join Dave on his final bar this week. Tomorrow, on Tuesday, February the 7th, Ari Wald of the Oppenheimer Group will talk markets with Dave. On Wednesday, February the 8th, it's Joe Rabel's turn. Joe runs Rabel's stock research. And on Thursday, February the 9th, Dave will be talking with Jesse Felder of thefelderreport.com. Please tune in as all three are returning, highly valued guests of StockCharts Television. It's definitely worth your time. And now let's continue on with the final bar mailbag, answering some Sector Spotlight questions. So the first question is about someone who's interested in day trading. So I'm an intraday day trader. What is the best RRG combination, daily, weekly RRG, to start zoning in for an entry point for a day trade? That's interesting because when you're a day trader or an intraday trader, I don't think the daily-weekly combination will work. The daily is just too slow. What you want to do is you want to have alignment. And for day traders and intraday traders, the good news is that we actually have intraday RRGs available on the platform right now. And what I do when I get a question like this, I want to bring up two RRGs side by side, because this is where I can show you what you would like, what I would think is the best approach. So for a day trader, intraday trader, your long-term chart is your daily. Your daily RRG is basically your long-term charts. That's the long-term trends. And for your intraday stuff, for your zooming in, you may want to go to 60-minute or 30-minute RRGs. That'll give you a look inside the day. And let me align this with the sectors here, make that a 30 minutes. So we have the same RRGs. So here you see the dailies. Quite interesting, by the way, to see the exact opposite of what we just saw on the weeklies. And here you see the 30-minute chart. So this is ongoing. Let's see if we can find any interesting moves. So here is consumer discretionary is right inside the leading quadrant. But you see that it lost a little bit of momentum here. And in improving, you can see that XLY is already pushing back towards leading. So that, for me, would be a nice signal, maybe even a little bit earlier when you scroll back, and this is earlier today. So this is 12:30, noon. You see that consumer discretionary starts to improve again. And you have a daily tail, which is inside leading and moving higher, and you can see the 30-minute tail to start picking up. For me, that would be something that I'd be interested in. And of course, you can do this on individual stocks. Doesn't really matter. You can do this for any universe. But what I would like to do is take in intraday cases the daily as the long-term next higher time frame, and then zoom in on 30, maybe 10 minutes. Depends a little bit on how aggressive you want to be with your trading. I hope this helps. Let's move on to the second question. And that question is, I am sure you heard of pairs trading. I just learned about it last week, created by Merrill Lynch in the early 80s. Is there a way to scan stock charts for stocks in correlation with one another? The answer is yes, there is. First of all, pairs trading, there are two schools to pair trading I need to explain. There is, I think the school that Merrill Lynch, that user mentioned for Merrill Lynch was, these people were looking for highly correlated stocks. So when a pair, whatever it is highly correlated, and all of a sudden the correlation drops, they would put them offside against each other, one long and one short, assuming, counting on that correlation to get back to that high level. That's one thing. What you do there is you are betting on very small price changes, because usually they move in a pair. So when there is a divergence, then it's only small until it comes back to that same high correlation level. So what you would need to do is you need to take very big positions to profit from a small price change. There's another school, which I like way more, and which you can do using RRG, is to look for stuff that moves completely the other opposite side. So with a pair that has a very low correlation, just like below 0, maybe -1, and moving offset to each other. Now, the question was if we can scan for it. And the answer is yes. What you need is the correlation coefficient. And if you go to the scan support center and look at the syntax for the correlation coefficient, you can find all of that there. And I have quickly set up an example for you. Now, what I did here, I took the S&P 500 as the universe, and I want to look for 20-day correlations with the S&P 500. And obviously, you can have massive groups, but I'm doing it very aggressively. So I'm actually going to look. Most of these stocks are highly correlated with the S&P 500. They are the S&P 500. So if they go up, they all go up. That makes sense, right? So what I'm doing is I'm going to look for stocks that have a very low correlation with the S&P 500, assuming that that's a very small group. And that can help me to offset trades with SPY and correlation. So if I run this scan, and I go super quickly, you can see, and it's very aggressive. So usually the groups will be bigger. You can see 3 stocks here that have a correlation that is smaller than -0.75%. That means that they are moving almost inversely to the S&P 500. This is how you can scan it, use it to your advantage. You can actually, you would be able to put these on an RRG and find opposite rotations. And that's where I would actually bring in, where's my RRG? Here's my RRG. So if I wrap that up, and we're going to call this the last question for the mailbag, otherwise we will have way too much time, too little time. What you'll be looking for your shorts somewhere here in the leading quadrant and rolling over, and you'll be looking for your offset longs inside the lagging quadrant. So in that way, you will look for trends that are rolling over and are losing strength. So they're coming out of a strong period, they're rolling over, becoming to come negative, and you look for offsets, you look for longs and stuff that are coming out of a lagging period and starting to pick up strength. Pairs trading is a very aggressive way of trading. So looking for shorts inside the leading quadrant and looking for longs inside the lagging quadrant is obviously very aggressive. Just bear with me. That is just what it is. So if you're into that, make sure that you know what you're doing. But in this case, the RRG can help you to find interesting combinations. Run a scan for a correlation or a negative correlation, whatever you wish. That narrows down your universe. Throw that on an RRG and see if you can find nice rotations that are offsetting each other. You want to be long something that moves in that clockwise rotation from 6 o'clock to 12 o'clock, and you want to be short something that moves from noon to 6 o'clock. That's basically the underlying premise. And narrowing down the universe using a scan for negatively correlated stocks will definitely be helping you. We're going to wrap up this mailbag segment. Please continue to send them in. I am now going to do my 3 in 3. And I needed to come up with some names really quickly because I'm not used to preparing this show, so it takes me a ton of time. What do I do for 3 in 3? Last week, 3 stocks came in, 3 mega cap stocks came in. They all missed their earnings. They all are very important to the S&P 500. I want to know what's going on there. And here's Google. You see that breakout that we saw. That's when the bad news came in. It sold off, but it didn't sell off far enough. We are still holding above that breakout level, which for Google, Alphabet, is roughly above $100. That trend is broken. We're above the previous high, which is good. We have a slightly higher low, and for the time being, we're still above that former resistance point. If Google holds up above 100 this week, at the end of this week, and relative strength continues, I think that Google is on the way for a much more upside potential. Looking at maybe 120 even. My second chart right now for the 3 and 3 is Apple. And look at that. Here also, a big surge, disappointed, coming back, but it didn't come back very much. We're still above that consolidation. So we have a break which sort of found support in this cluster of lows here. You can see that all these support areas are kind of support zones. They're not to the dot. But what I'm impressed with is the capability of the market, and for Google and for Alphabet, to actually hold their breakout levels despite these weak earnings. I'm messing this up. So here, this was Google. So here's Apple. So basically, let me wrap this up for you. So here's Amazon. All these stocks are the same. So Amazon, Google, and Apple, they all missed their earnings. They all broke out. They're all reversing their existing trends. And when they miss earnings, so basically that's bad news for the market, they are not sold off. And I think that what it tells you is that there is underlying strength. When a market absorbs what I think can be considered bad news this well, it means that maybe the market is tired of selling. And that's good news. Put that in line with the market rotating out of defensive sectors. Look at all these big cap names that miss earnings, which is quite negative, and they're sold, but they're not massively sold. As a matter of fact, investors are coming back today to buy it. That's all good news. So I'm trying to make sense of the underlying supply and demand for these stocks. And from what I see now, from the take that I see now, there is underlying demand for these mega cap stocks. While the market is selling defense, it looks as if they're moving back to consumer discretionary stocks like Amazon, to technology stocks like Google and Apple. All in all, I think that is good news for the market. Ladies and gentlemen, thank you so much for bearing with me. I really enjoyed doing this. We're going to give Dave a few more occasions that he can take off, and I'll be happy to take over. I'll be a little bit more experienced, but I'll never be able to do it as Dave does it. So as a matter of fact, I'm really happy he's back tomorrow, because it's a ton of work to do all of this. So thank you, Dave, when you're listening to this. I'm very glad that you're back tomorrow. Everybody, thank you very much for watching. And please watch the show tomorrow when Dave Keller is back with the final bar. Thank you very much.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.